Newsflash, you don't have to raise capital to be a real estate investor. You can just find someone who does raise capital and work with them. And you work in some of the other sectors of real estate investing that are also necessary, that also people are bad at.
Welcome, investor, to another episode of the Passive Income Adventures. Today, we are talking about raising capital. So whether you are an active real estate investor looking to raise more capital to do more deals, or you are a passive investor looking for passive income, this is a great episode with Matt Faircloth to learn the ins and outs of how to both raise private capital, but also to be a private capital provider, whether that's through partnerships in equity deals, being one of the team members, or through cash flowing debt investments. We talk about both. We talk about the future of where the industry is going right now as interest rates are going up and appreciation is going down or not appreciating as fast as it was in previous years, and how that's helped us to pivot our investing philosophies and where we're going. We also talk a little bit about what retirement looks like, and one of the best quotes I've ever heard, where we talk about if retired people really enjoying the retired life. I think a lot of us with passive income adventures, even the title of the show, talks about the kinds of things that we're going to do when we're living financially free on passive income. And we don't call it passive income sitting on a beach. We call it adventures. What kind of adventure do you want to go on? So really excited to have Matt here today. We were reading his book as we were driving out to Orlando for the conference. And if you're watching on video, I'm sitting in a gazebo. We've decided to stay in Orlando for about a year and get to know the investor community locally and enjoy having a new adventure with our kids in a new place that's completely different for us. If this kind of lifestyle appeals to you, then you might be better off as a limited partner. We also talk about the type of person that would be more suited to active investments versus, say, being a complete passive investor. And we also talk about how to diversify between those two things, because it's rare that you find somebody who wants to do 100% of one or the other. So figuring out where you fall in along that spectrum is one of the most useful things you're going to get out of this episode. So thanks for joining us today, and on to Matt Faircloth. All right, we are live with Matt Faircloth. Matt, thanks so much for being on the show. I am excited to talk to you because we just drove across country in our RV to the Bigger Pockets conference, and we're listening to the Raising Private Capital book that you wrote. And then I booked you on the show, and I thought, okay, great. So now I get you to myself for a little while and ask you all the questions that...
Thank you. I wish I had these. In some ways you wish they were a week. In some ways you wish they were 30 minutes.
Yes.
But in the way that I wished it was a week is I wish that we could have done this live. And I know that was originally the conversation, but as you know, you tend to squeeze like 3 days worth of work into 18 hours at these conferences, right? So I would have liked to hang out with you live. I know we talked briefly about it, but I'm grateful to be here. Thank you for having me.
Yeah.
And thank you so much for listening to my book. That's awesome. That's not me. I've lost my voice by talking so much at BPCon, but that's not me reading the book, just so you know.
Yeah, so whoever the author was, he pronounced some stuff funny, real estate terminologies. I figured it wasn't really Matt reading it, but I feel like...
I wouldn't have done that. I also heard I heard he coughs in chapter 4 or something.
Oh, I did not catch that, but I think what I really liked about it was I felt like it takes you through the process from raising capital I don't know anything about real estate all the way through to doing some large funds. Mm-hmm. But what I got out of it was a lot of details, like proper paperwork even, because I know the first time that I loaned money to somebody, I really was not even sure if I was doing it right as a lender, as a private money partner, and wondering if it's a scam and they're going to run off with your money. And so I did really appreciate that part, walking people through it. Where I felt like I was going to the conference, and I go to every conference with this intention, is to raise more capital. And so we can talk about that and like putting yourself where people are and finding out where the people, your avatar, where they hang out and where to go hang out with them. Because like we're saying, multifamily conferences is not the best place to raise capital from other multifamily syndicators. So you're trying to put yourself where they are. So let's just jump into... Give me a little bit of the lead up to this conversation that we're having. I liked in the book how you started out from, I don't know anything about real estate, all the way to now I'm writing a pretty exhaustive book on how to raise private capital. So tell me a little bit more about where you started for our listeners that aren't familiar with you, like all one of them, and introduce yourself a little bit.
Yeah, no problem. So I got started in 2003 in real estate investing when my girlfriend at the time, now wife, put Rich Dad Poor Dad in my hand. And that really blew my mind. I went out and bought the cash flow board game and started playing that. I went to local RIAs and I met guys and gals around my age at the local RIA club. And I was like, hey, let's hang out and play cash flow. And so we started doing cash flow games every other week. And that it really just opened up my eyes to what was possible and into what real estate investing could look like if I were to do it as a career. Fast forward to 2005, Liz and I get married, and we figure out that if she got a job that had this starting salary X, and we lived below our means a bit, I could quit my job. We didn't have to be dual income, right? We could live off just her salary. So we had to buy a little bit smaller house than our money said we could afford. Then our mortgage broker's like, hey, you guys are earning all this money. You both have these really good jobs. Why do you want to buy this really cheap house? And I'm like, because you don't know. Look, you don't know what we're doing because Robert Kiyosaki got into our head. I quit my job in 2005 and started scaling up the Rosa Group. In that time, while we were dating, I had bought a single family home that I lived in. I'd rented out 2 bedrooms to 2 buddies of mine. Liz and I together bought a duplex. I'm giving ourselves another unit there. And bought ourselves a duplex that we leased up and did well with. And those were our 2 rental properties when I quit my job. I had my single family home that was producing cash flow and the duplex was producing cash flow. And we just took it from there and bumped into a lot of walls, got through the crash of 2008, tried a lot of things, tried some things that didn't work, did a lot of fix and flips, did some wholesale deals. But where our passion and our income kept coming from was in long-term rentals. And so we bought more and more long-term rentals and decided to, over the years, started to just drill in and focus more and more on that. And one day, Liz is getting reconnected to somebody she went to grad school with and just saying, hey, my husband's doing this real estate thing and I'm working. And her grad school buddy says, real estate, that sure sounds interesting. I wish I could do that too. I just don't have the time. And she said, oh yeah, it's a lot of work. She could have just said that. But she says, you should talk to my husband, right? And we'll get into a bit in a second here, Emma, about like how that conversation happens to everybody and people should leverage those conversations to raising private capital. But fast forward from there, I met this person. He put $50K into a deal with us that we had found. And then he starts telling his friends about us. Then we start telling other people that we knew about what we're doing. And before you knew it, we were buying small apartment buildings. And years later, we scaled very quickly and 10x'd our business in a time frame, right? So now our company sits on about 1,800 units of multifamily assets in 4 states. We're fully vertically integrated. I've got a deep bench of our team, and we're really going all in on rentals with a mantra to transform lives through real estate. So we've really pushed into it. It's been fantastic. And we currently control $56 million worth of investor equity.
Nice. There are a lot of similarities I'm hearing. I came across the Rich Dad thing like 2000. And I read it, and I don't remember being particularly moved by it because I had already been talking about, I called it residual income back then. Yeah. And I wanted to go make a lot of money at some summer sales job and then pay for my college and start investing what was left. And so that was what I was doing in college. I came back to it probably 20 years later and discovered RIAs. And now we were in your situation where one spouse was working and I wasn't working because my husband got a job and I left my business behind and I wanted to start another business that made more money than my photography business. So I ended up at real estate stuff, business networking, week after week, get up there and talk about different aspects of how to make money in real estate and listen to what really resonated with me. Even back then, I was really after the passive income. So looking at rentals and looking at scaling larger buildings, that kind of thing. And I realized that I was really limited by the amount of capital that I had and by the amount of capital that I could raise. And so I really dove into raising private capital. And here we are 4 or 5 years later, and I am a little ashamed to admit I'm still pretty terrible at it. I've been working at it really hard, and it's something that still seems to elude me. People don't even have time to research investing passively, just putting money into a deal. So how much research did he have to do to feel safe investing with you? Or do you think it was at that point 100% trust play? And how do you deal with that objection where people are like, I don't have time to invest in real estate, but I don't even have time to figure out how to invest passively?
Yeah, there's a lot to unpack there. So let's get after it. Most people that are going to be your first investors, not you because you've already done it already a bit, but let's just say somebody's listening that's never raised capital before ever and wants to pursue that as the lane of real estate investing they want to do, meaning raising capital. And put a pin in this if you want to come back to it. Like newsflash, you don't have to raise capital to be a real estate investor. You can just find someone who does raise capital and work with them. And you work in some of the other sectors of real estate investing that are also necessary, that also people are bad at, like dealing with contractors, dealing with dealing with property managers, finding deals, those kinds of analyzing deals, those kinds of things. Nobody's great at all the different facets of real estate investing. So raising capital is one of the facets of real estate investing. Okay. And let's put that over on the shelf there if you want to come back to it, right? The thing is that this person said, geez, real estate investing, wish I could do that, but I don't have the time. He, after one coffee meeting, was ready to give us $50K. Mm-hmm. And when I found the deal, as part of his due diligence, put himself on the train. He lived in Manhattan, and the deal was in Trenton, New Jersey. So he put himself on a train, came down. I picked him up at the train station, showed him around Trenton, showed him the deal. I said, okay, cool, this will work, right? Fine. But he also was investing with us because he knew my wife. My wife was one of his friends, right? And I strongly submit to you and to anyone else that your very first circle of real estate and of investors passive with you are going to be people that like and trust you because you're you. It's going to be having nothing to do with your deal or nothing to do with you, with like your investing strategy or whatever it is. They like and trust you because they know you and because they think that you're a good person. They've already vetted you on a personal level, right? And of course, they're going to do due diligence to make sure the deal doesn't smell hokey and that kind of thing. But they'll be halfway there because they already know you, right?
Yeah, I think my first 50 or 100,000 that I raised, we were doing a 506c syndication. I had never raised a dime. And I said something on LinkedIn about how my husband got laid off, and I felt like I had put him in a position where he was a sole income earner for a family with 6 kids, and that I felt responsible for the stress that he was under during that period of time because I really wasn't doing much. I had a little side hustle cottage business, but I wasn't doing enough to bring capital into the family, money into the family so that we could withstand these frequent layoffs in the tech industry. And so this investor saw that. It was just a comment I had made on somebody else's post. Like you would have said something, I would have commented on your post. And he reached out to me and he said, I love that story. I want to help you. I want to help you build your business. And he was my first investor. So even though he didn't know me on a personal level, the personal story is what touched him and what made him feel like, I want to help.
Did you look like, oh, Emma's going to pay me like X amount of dollars in cash on cash? Mm-hmm. And that like translates to all conversations with investors, even investors that we talk to now. Like I said, we manage $56 million of other people's money in our deals. Now, the conversation you have with investors is rarely about the deal in the beginning. They're going to want to hear about that eventually, right? But it's first about you, your company, your origins, where'd you come from? Like you said, your backstory, 6 kids, mom with real estate experience, with entrepreneurial experience, living on the road. All are amazing stories, and people want to be a part of something like that. Like they want to be attached to your grander you, not just that deal that's going to pay me 8.7% cash on cash return, and that's why I'm investing, right? So yeah, that's an awesome story, but that's why he called, is because you probably got real in your post. And so I recommend everybody make sure you get real about what you're doing, but also make sure your community that you are in, everybody that follows you on social, people you hang out with, make sure they know you're investing in real estate or that you're active as a real estate investor, because they probably see you as someone else right now and they don't see you as an active real estate investor. They need to change their view of you. You need to teach the world how to view you differently as someone who could funnel them into real estate, because currently they see you as just this awesome, amazing human being that would crawl over broken glass for them and would do anything for them, and they've got you in their phone if they need you. But they've got to change that shift in the way they see you.
Let's come about this from the other direction. I think one other thing I got out of the conference was how many investors there were saying they were struggling with the idea of becoming a passive investor because they can't give up the control over their assets, but they recognized, or some of them recognized it, but some of them didn't, that the only way to actually retire is from passive income. So if we look at the standard retirement, you put the money in your 401k, you build it up in the stock market and in your some S&P or total market funds, and then you start living off of 4% of that, completely passive. You don't have any control over that, and the money's coming out and you're taking your minimum distribution. And that's how most people retire, is on 100% passive income. But for some reason, I think that gets sometimes lost with real estate investors, because they think that to be an investor, they have to own the rentals, they have to find the deals, they have to do that. But most of the people I know who are actually retired on passive income have never owned a deal, or they've owned a few rentals, but they've scaled up by passively investing. So talk to the passive investor about what that looks like and how they find the time to figure out this whole thing and how to invest and how they get over that control issue.
Passive investors understand the magic equation of real estate investing, which is that real estate investing to be successful requires two things, right? It requires money. I got it. And they got money. Maybe it's in their IRA, by the way. So my secret to that active investor is I can't take my hands off the wheel. You also can't put your retirement account into your own project.
True.
So why would you not take your IRA and put it with another active operator that you trust, right? But the equation is money in a deal, maybe from an IRA, and the other side, time, resources, contacts, business acumen, control, stress, risk, all that stuff, all is on this side. But most importantly, time is the biggest thing that's on this side of the equation. And a passive investor gets, I'm going to take the money that I'm earning, probably doing something else. Maybe it's real estate investing, maybe it's fix and flips, maybe it's wholesales, maybe it's being a chiropractor, but whatever it is, I'm going to take that money and I'm going to invest it. And someone else is going to take their time and making me a great return on it, because a passive investor truly understands that the only limited resource in the entire world is time. There's as much money as you want, deals as you want, people as you want to meet, all those things. The one thing you will never get any more of is time. And so they are able to leverage other people's time to make them cash flow. And if you pick the right operator, you're willing to relinquish that control so that I can have my time back. So if I'm a chiropractor, I can go crack a few more backs, or a dentist, I can go do a few more root canals, I can go do whatever it is, or I can go hang out with my kids while someone else is doing things to make me cash flow. That is the magic of passive investing, it is cash flow while I'm doing something else, whatever that something else is.
I think that answer takes care of the time factor too. When people are saying, I don't have enough time, what they're really saying is this isn't important enough to me. Because when it becomes important enough, you somehow magically create the time. And you don't actually create time, like you just said, but you know how to prioritize and move some things that are less important down so that you can spend some time learning. As drilling in that importance, what really helped me was I was a little bit burned out, and I was trying to make as much money as I possibly could, as fast as I possibly could, because we wanted to retire early. As burning out and realizing that I couldn't continue to scale unless I started a big business and hiring people and become vertically integrated and all that. I had to make that decision that you were just talking about. And I decided, no, this isn't why I got into this. I got into this for passive income. But most people are hustling, running a business and talking about scaling it. And I just had to sit back and say, I need to take lower returns, because you're always going to make more when you're an expert at something and you're putting your time into it, because you're trading your time for money, right? I'm going to have to take that time out of it and just make the return on the money only, none on my time. Yeah. And I had to become okay with that, because I felt like it was an important part of my diversification strategy. I'm going to do some deals here, some deals there, and some of them are going to be completely passive. Not all of them, but at least some of them, so I could get my time back and focus on my business, because I was running ragged and I needed to make more money. So the solution to that was to find another deal, and I just didn't know where I was going to fit it in. And that's truly not having time.
Yeah, it truly is. What was funny, Emma, is when I was at BP, it was just relevant for you and I both, because we both were there, right? At the Bigger Pockets conference, I was talking to a investor, and she was like, I want to retire, want to get out of the game, want to get out of the rat race. And I was like, okay, great. There's other companies here that have passive investments. So do we. And we have a fund, and we paid 10.7% annualized last month, right? And like on our fund, I'm like, that's pretty good. I think I'm over here high-fiving myself, because it's hard to get 10.7% passive, right? It's not hard. It's not everybody's paying that out, right? There are other people that pay that, or maybe a little bit more, but on a monthly basis in cash flow, 10.7% is something that's towards the high end of the spectrum, right?
Yes.
In a passive, no effort in. And she was like, I want to make more than that. I want to make like 20%. And I said, okay, you're not going to make that passive. You're just not. Maybe you can get on somebody's apartment building deal and they catch lightning in a bottle and it makes you 20% cash on cash, 20% IRR, God willing, and the creek don't rise. And because the apartment building sells 5 years from now, and you make that annualized, right? But there's a lot of things that have to happen for that to happen. But you are not going to make 20% passive unless like you're going to the roulette wheel, right? And taking gargantuan amounts of risk.
You got to show up at the roulette wheel.
Unless you want to put in time, right? You can certainly make 20% cash on cash if you wanted to inject time into the business, but you're not. If you're going to have to compensate someone else for their time, and that time is not free. This is not a not-for-profit. This is not a hobby for any of us, right? We all got to make money too. And so your active operator needs to get compensated, and that's going to dilute a bit of your returns. Like you said, a little bit less money, a little bit less cash on cash, in exchange for zero time. And that's really where the magic happens. I don't know if her light bulb went off at the time, but I was just like, best of luck to you. You might as well just go and buy yourself an active rental property and find the contractors and pick it up yourself if you want to make 20%. Because I think she was stuck with that number, but she understood maybe that's what she's going to have to do to
like
see
when
that kind of return.
You remember when you first started looking for properties and maybe you had a mentor or somebody tell you read a book or something, I'll buy things when they hit this buy box. And so you go to the broker and you tell them what you want and they're just chuckling at your beginnerness. You're really looking for a unicorn. And I think sometimes when we're beginners, we're hearing things that other people are saying. But then we go out and do some real world research. We realize that maybe our expectations are a little out of balance. And so
I remember some of the crazy stuff I used to tell brokers I wanted. I was like, I want a bank foreclosed 10-unit apartment building that I want the bank to do seller financing, and I want to get it at 100%. I want to get it no money down because I don't have any money because I'm broke, and I want to buy a 10-unit apartment building even though I don't have any money, and I want to pretty much just get it with a cherry on top, right? And they're like, okay, good luck with that, right?
And you can tell when they know you don't know what you're talking about. How much time I always recommend a new passive investor who might be business savvy because they maybe have a high paid profession or something. They're maybe not starting at zero, but maybe zero in real estate other than buying their own personal home. I usually tell them, I said, you need to dedicate maybe at least 5, probably closer to 10 hours of learning. Read a book, listen to some podcasts, look over some pro formas. What do you think would be a reasonable amount of time for your average professional or entrepreneur to be able to say, I feel reasonably confident I can place money into a deal?
For a passive investor, you got to research the industry, maybe get some talk. The worst thing people think that this is a great question when they want to passive invest with us, right? This is the worst question in the world. And let's say, hey, can you give me some references for other people that have passively invested with you? Okay, here's the deal. You ask anybody for references, they're going to find you. They're going to give you their mom or somebody who just loves them, who thinks that they're amazing no matter what. They're going to give you the best pick of the litter, right? We sometimes, when people ask us for references, because I know that they're really going to sing and talk about how great we are, we've given them people that we've had problems with and that we worked it out. And they were like, okay, yeah, this deal didn't go so well, but then DeRosa Group worked it out. But most people don't do that. They're going to give you the best references ever. What you want to do if you're trying to vet a passive investment, one thing you can do is go and talk to people that are passive investing, but not referrals of someone you're vetting. Go online and find a real passive investor, or go in your communities, go on biggerpockets.com's forums, or find someone who's fully passive, or has a lot of passive investments, and ask them about what they're up to, other operators they like, investment classes that they like. The problem is when you start looking at different things to invest in, you're going to be like a kid in a candy shop. You're going to be like, oh man, I'm going to invest in a self-storage syndication, and I'm also going to invest in an apartment building syndication, and this oil and gas thing sounds good. And also there's these ATM. Did you know you can buy ATM machines as an investment? They literally spit out money. That's what they do. I can own that, right? There's all these different things that you can get in, and they all look incredible. So I suggest that people start researching, ranking these things, watching social media platforms that are broadcast by some of these operators like us, our YouTube channel, right? And spend a lot more time than you thought, maybe not even 10 hours a week. I would talk about it in months, right? Like maybe a certain amount of time over a period of 2 to 3 months of researching, vetting, and then starting to rank asset classes. And the reason why they got to do that is people have different needs. Not every investment has the same time horizon. Not every investment has the same tax leverage. Not every investment has the same initial cash flow. Not every investment has the same opportunity for it to 2, 3, 4, 5x, right? You want to put $1 into something and have the chance to get $100 out, right? It's not real estate. It's maybe joint ventures or maybe like a tech startup or something like that. The question is, what do you want your money to do? And when will you need it back? Those kind of questions you should be asking yourself as you research these things, and investments that will start to make sense for what your goals are, what your liquidity requirements are, for what your tax needs are, for what your comfort level is, what your risk factor is. You might not want to take that much risk at all. And so you might be okay making 6, 7, 8% on your money, right? All these questions need to get asked of yourself, of your goals. And then after time, after like months, things will start to float to the top about what makes sense. Then you find yourself people that are actively working in that industry start to vet them, go to their webinars, and it won't all smell good anymore, right? Then somebody that's offering an ATM deal won't make sense to you because that doesn't meet your goals because you've thought about that, right? You'll start to know more about what you want, what you don't want, and you'll be able to nail down operators. If you don't do it the way that I just said, then it's all going to look incredible. It's all going to be shiny nickels, and you're going to be looking at a self-storage deal on Tuesday and a multifamily deal on Wednesday and a land development deal on Thursday. And they're all going to look amazing, and you're not going to know what to do.
Yeah, I think sometimes just going through deals, and when you get to the point where they all look the same, like every multifamily deal you look at looks the same, and every self-storage deal you look at looks the same because they're all, yeah, now you're looking at enough of them that you know what's normal, and you know at least when something looks a little better than normal or
too good to be true, you mean?
Yes. So
if you look at enough deals like, hey, this guy's offering a 50% cash on cash return on a multifamily property.
Yep.
You and I have looked at enough deals. We know that's not possible. Not possible, but that's so far outside the spectrum that it's suspect, right?
Yep.
That's the nicest way I can say it. And if you see that, you're not going to get duped. Because if the first thing you look at, it's like, hey, this guy over here I just met on Facebook says he can get me 50% return on my money with no risk, you might get in that deal. And then you're maybe in something you don't want to be in, to say it nice too.
Yeah, I think that's the point where once you learn what's normalized, you know where to start digging in a little bit more and seeing everybody can doctor up their numbers a little to come out at that average, industry average. And then you need to say, okay, how are they arriving at these? And when you get to that point, I feel like that's when it starts to become a lot more time consuming. So people have
the next thing is you learn the levers, right? Yeah. Like once you've chosen the asset class, once you start to look at a few operators, then you start looking at deals, then you start to notice and maybe you look to talk to a few passives that have looked at a lot of stuff, make some friends in the industry that are on the passive side. You start to learn the levers that people do. Like multifamily, just for an example, right? Multifamily, a phenomenal lever that people love to touch is they pull out this thing called a crystal ball and they tell you what the future is going to look like. They're like, 5 years from now, when I go to sell this property, the market's going to be this, and it's going to produce this cash on cash return for the new buyer, and I'm going to sell it at a 4% capitalization rate, right? Meaning, I think the future is going to be amazing. The future is going to be like what the world was 2 years ago before the Fed started increasing rates, right? Mm-hmm. And rents are going to do this, rents are going to do that, right? And so if they paint the biggest rosy colored picture of the future, right? And that makes the deal look really good on paper. That is the lever that you want to be careful of because the future might not happen that way. As we all know, things don't maybe exactly work out the way that we think that they're going to in the future.
Before we jump in the future, because I definitely want to ask about what you're working on and what you're planning, what your adventures are. Just real quick, what are you doing right now to find and attract new investors? Where you're going, where you're spending your time? Don't tell us exactly because you want to be the only real estate investor in the room. But what types of things should we be looking for if we want to find our investor out?
I am transparent. I'll tell you it all. I'll tell you the whole thing into a microphone on your podcast so everybody can take notes. 30% of our investor base, of our $56 million, 30% of what we manage comes from some sort of medical trade, right? That could be folks selling medical devices. They are in that box. That box also includes dentists, folks that are some sort of a specialist in medical trade. So believe it or not, anesthesiologists tend to have a lot of money to invest passively because they work a lot because the world needs them. And I don't want to be awake when you do surgery on me. Anesthesiologists tend to put in a lot of time. They also tend to make a lot of money for what they do, as they should, because it's a high-risk profession.
Highest paid specialty.
They're pretty much almost killing you and then bringing you back.
Pretty much.
That's what an anesthesiologist is really doing, right? So it takes a lot of trade, a lot of practice, a lot of focus to be able to do that. So a lot of our investors are anesthesiologists, so specialized medical professions. And I joke with many anesthesiologist friends, and that's what they say they do is they almost kill you and bring you back to life. So that's their quote. Then you've got the alternative specialists like chiropractors and also pharmacists.
Yes.
They count in that book too. So any medical related trade tends to contribute. They constitute about 30% of my investor base.
Yeah.
The way that we work on attracting investors is to speak to that community. And so we are working on doing more doctors conferences or going on doctor podcasts because those do exist, right? So that's a tip for your community, right? this is an easy lower hanging fruit. Okay. So that's where we are, right? For our size. But if someone hasn't raised that, if they're not, haven't hit that level yet, and they're gonna, but if they haven't hit that level yet, then an easy place to go that is smaller, but it's like low, it's like the fruit's almost dragging on the ground. It's so low. And that is retirement accounts, self-directed IRAs, right? So get to be friends with a self-directed IRA custodian. Okay. Mm-hmm. Come up with a webinar presentation and give it to their community of IRA holders, and make it not a commercial about you, because it's not going to work. Make it just about why real estate investment is amazing. Make it why the market you've chosen of Topeka, Kansas, or whatever it is an amazing market to invest in, right? And make it by why your company does things a little differently, right? That could be a presentation you could do. There are $10 trillion with a T, $10 trillion in IRA accounts, not 401ks, just IRA accounts in this country. 4% of that money, is invested in anything else aside from Wall Street. So that is a tremendous opportunity for us to move that needle. As the math that I had was, for every little bit of a percent, it's billions of dollars that come over to real estate investing. For every little smidge of a percent that we can move that number a little bit higher. So anyone listening right now, anyone knows someone that used to work at this job and now works at a different job, right?
Yes.
And if they used to work at job A and now work at job B, as we all have, right? Most of us have changed it. The average American changes job every 7 years, right? So if they did that, then the retirement account at job A is now capable of being rolled into a self-directed, right? So look through your Rolodex of people that used to work here and now work there. IRAs are a phenomenal place to start. That's another 30% of our business is IRA accounts. And so that initiative that I just told you, the doc thing is good too, because doctors have lots of money in no time, right? But on the other side of it is everyone, your next door neighbor right now has an IRA, and it's probably sitting in like a mutual fund making 2.5% yield, right?
Yeah.
You could pay a lot better than that. So that's like a big tip. I don't know if that helps.
Yeah, I think that a lot of us who are interested in the passive income lifestyle, who are listening to this program, a lot of them, my listeners, are a little bit on the fence. Should I buy a rental house? Should I buy an apartment building? Should I become a syndicator? Should I just passively invest? And so I just want to give the real story, the full spectrum of what it's like all along, from 100% passive all the way to I've never done a passive investment in my life, and I own 50 rental houses and I manage them all myself. Where do I go from here? Because this is all about the passive income adventures, about true financial freedom and retirement. Now, not saying that I want to retire, because I get bored easily and I like to go do some things. Pull out your Faircloth crystal ball and look into your own future professionally and personally, and tell us where you're going from here, because a lot of us are working because we choose to be working because we are financially free. And then we're looking for Emma or Matt 2.0 or 3.0. What does that look like for you?
Yeah, meaning, have I predicted where I think things are going to go given all the wackiness happening in the world?
No, economic crystal balls. Anybody pretend I know. Yeah.
I'll tell you, I'm very straight. And as a business owner, for you and I, we can't just act on today, right? We've got to do things that we think are going to play into where we think the hockey puck is going in the world, right? And I'll gladly speak into that if that helps, right? Again, I don't know. Is the Fed going to raise the rate again in November? Who knows, right?
It's not going down.
That's not what we're talking about. But what is we're talking about is what we are doing to play into what I would call the new economy. How about that? Okay. The last 10 years, 30-second history lesson, right? The last 10 years has been a time of low interest rates and high growth, right? Family has made everybody look brilliant. And there's people out there that have made gajillions of dollars and are Facebooking all about it, because the market made them look brilliant, and because the market was taking off, and they bought a building for $10 million, sold it for 20, and didn't do anything to it.
Yeah.
And they just, hey, lucky us, right? Look what I did. But that is an appreciating market, and that happens when you have low interest rates and a thriving economy. And that's just what we've had, right? We've had rents booming up. We've had money flowing around like water, thanks to the government printing money and thanks to just the economy being solid for the last 10 years. 10 years. We haven't had a real recession since 2008, right? So we are riding on an unprecedented growth economy we've had, and then also with rates being down. That is changing. And of course, rates being down, that's over. That party stopped. That was fun. So that's not going to happen anymore. That's not there anymore. And I also believe that the growth rate, the rate that the economy has grown at, the stock market, everything else is going to grow less. Maybe not crash and go into the toilet, but there's going to be a lot of strain on the economy, international strain, everything. And so we're just not going to be at this awesome party that we were over the last 10 years. The next 10 years may be flat or maybe just slow incremental. The investment strategy that we are implementing to make it work for that is cash flow, right? So we're not investing for appreciation anymore. I'm okay buying an apartment building or an asset. Like we looked at a hotel the other day to buying hotels, right? And hotels historically trade for around what you paid for, right? Like I could buy a hotel for $10 million and then sell it 5 years from now for $10 million. But it sounds crazy. They need a lot of work to get on, but they also cash flow really well. They make, if you buy the right hotel, it could make a double-digit cash-on-cash returns in cash flow the first year you buy it. So we are looking at things that cash flow very early in the ownership cycle. I was investing in 2008, and so if another crazy fallout 2008 happens again, what got me through 2008 was cash flow. Rent coming in from my property, tenants paying rent. Tenants stop paying rent, I can replace them with new tenants that do pay their rent, right?
Yeah.
And that was able to service my, and some months not make any money, but at least I got to keep the property in the market, right? Didn't go into a real estate thing, right? And some months paid me cash flow. And then over a long period, it went up in value, right? So we are investing here in cash flow. We're investing in debt. My company's, we're out there, we're ending money. We're in hard money. We have a lot of money. Personally, Rose and I have a lot of it, hard money loans out. And we started a fund that issues hard money because I like the cash flow that comes from it. I like the collateralization that comes from it. So if things get squirrely, at least I'm lean on the property, right? And it's typically a first position lien. And I like investing in things that send me a monthly check, right? I'd rather have a monthly check than something that I hope is going to 3x in value anytime soon, right? So that's what we're doing. We're also looking at other real estate sticks and bricks investments that cash flow day one as well. And we've got a few first leads that we're looking at too. So
now that's actually really helpful because I feel like because we retired in just last year, just as things were starting to come apart, we really started focusing heavily on cash flow personally because that's how we're going to live. You can't eat equity. You can't bring equity to the grocery store. Yeah, you got to pay your bills and we need a cash flow. And so as we're transitioning from yield investors over to cash flow investors, it seemed to coincide perfectly with the time when most people are starting to think about cash flow because the appreciation is going to, in my opinion, my crystal ball, be stagnant for a little while. And so we also have opened up, our fund really specializes in debt. It's 3C5, so most of it has to be debt. And then we can bring in occasional equity projects for the tax benefits because if you're making a lot of cash flow, you're going to get killed on taxes, especially if you're W-2. So we want to bring in some of those depreciation things. And you just maybe confirmed with your crystal ball that we're barking up the right tree here because I feel like right now debt, reliable income that doesn't take appreciation into account is the direction that we are pivoting. We used to do some private lending. We're doing a lot more of it now. I still like multifamily. I'm still heavily invested in multifamily, but it needs to be a cash flowing multifamily at this point if I'm going to go into a new deal. So that's become very important for us as well.
Family at a 5% capitalization rate, but there are multifamilies that I've seen that are trading higher. And so the things are shifting. You want to just listen to this podcast and just like, oh, I'm just going to sit in the waiting place and wait for things to crash. Probably not. You got to keep your finger on the pulse because I'm seeing we're looking at an apartment building in the Southeast, right? We were second best bidder, right? First best bidder just dropped out. They're coming back to us. We were 5% behind the first place bidder, right? And so we're getting another look at the property and we were 5% less than asking on the property. So think about that. That means that property may trade for 5% less than the seller wanted. A year ago, it would have sold for 10% more than what the seller wanted.
Yes.
And so this is real time. Real estate investing is a real time thing and prices are changing overnight. And so I think that in more places soon and maybe now.
Yeah, I agree. And what we're seeing cash flow other than debt is our active businesses, like you said, hotels that have a real estate component to them and old stuff. I hate to say, but old stuff that's already cash flowing well because it's already stabilized and it's been kept up. It's not value add, but it's old. And I'm seeing those things are doing very well. And I'm really grateful for the experience that I had in construction management on the value adds, because now buying something that's a little less than Class A doesn't scare me.
Yeah, I wouldn't get into Class A today because Class A has pushed up so much last 3 to 4 years that if we see a real slowdown in income and if we see real like double-digit layoffs and stuff like that, is the first place that's going to feel it. People are going to start dropping back their budgets. Maybe I don't need to live in a bougie apartment with an iPad in the wall and a dog washing station, right? Maybe I can drop and move in with my parents or move with my brother-in-law or just live in a cheaper apartment and save $100 a month, right?
Yep.
So I think Class A is going to feel the strain.
Yeah, it might be a good time to, I think it's a good time to start a Class A development, because by the time it's online and getting into its absorption, hopefully all this will start to be behind us. But I like new development right now. New development was not penciling for a long time, but now we're finding the new developments penciling, and cautiously going into that area, something that we're doing a little bit of, just because I feel like it buys you some time before you have to start renting it up.
What was it?
I don't know. We lost you for a second. Hey, Troy, you want to check that and edit that part out?
Okay. Yeah, we should just jump back.
No.
It's a good time to build Class A.
Yeah, if you're gonna do Class A for me right now, it's only new construction. I wouldn't buy one, but I might build one for that lead time before I have to start convincing people to move into a really nice place.
Construction is like a real internet. You just go out, you church, and it's like you expect, like whatever I'm going to run this thing into, it's going to be a different economy than we have today. And I think if things get weird for a little while, the Fed's already talking about big rates and it's maybe not to anywhere near where it used to be. But you probably could ride the wave down a little bit and borrow money for a lot cheaper a year or two for two. So if you can afford to do it, if it's the right development, I would be building class locally, building it, taking your time, just painting really slow like this. And then when you're leasing up, we could be past whatever we're at.
Yeah. Again, crystal ball stuff. But where do you see, just to wrap up, where do you see yourself in 5 years as an investor and as a human? How are you looking to spend your time, say 5 years from now?
Let's do that. My 50s 5 years from now. So I think that my kids will, that's what it's really all about. That's when you go on the road. Just you probably show America to your kids. I get it. Feel that, right? My kids will be 15 and 11 5 years from now. And so I will probably be starting to count the days that I still have that before they're out, right? On their own. And so I was spending a lot of time with my kids. So hobbies probably dissolve and go away. It's all about the kids. I would also say that I love what I do. And so I also don't be happy retired people. And so I don't want to be retired because it doesn't seem to bring happiness. It's almost like the natural thing, right? Yeah. So I want to still be doing what I do, transforming lives through real estate. I just want to be doing it on a different level, let's say. And I'd like to be assisting and guiding your people. My book, Raising Private Capital, has done very well. And I actually enjoy writing books. And so I'd like to take the time over the next 5 years to write at least 2 books, if not 3. And so I can see, I also love being on stage. I love like assisting other people, going through, talking more through a thing on a stage. And so I think I'll be doing more speaking, more traveling with my kids. It would be phenomenal. Maybe I'll be an Emma one day.
Yeah.
And travel around the world, talking about a book, do it. Public speaking, I don't know who knows.
Yeah, you're basically describing.
I think it'll be this in another way.
Yeah.
It'll be what I do.
Yeah. Oh, I feel like you're describing exactly what our goal was 5 years ago, because my youngest is 11 right now. And I just feel like the clock is ticking on having the kids home. And I just felt like it was just time to do something. And I feel like our goals really aligned, because I asked my kids, I'm like, they're homeschooled, dad's not working in an office. Where do you want to go? And they're like, Disney. And I'm like, I'll go to Orlando, because I think the investing community there is robust and I want to network in that community. So we end up in Orlando. We'll probably be here for about a year. And I feel like the kids are happy because they can go to Universal whenever they want. And I can go to all the real estate networking meetups. And just being able to live this life at a little slower pace. It's not retirement, but it's definitely not the hustle. So I'm really enjoying where we are right now, for sure. It's pretty good. Awesome. Thanks so much for being with us, Matt. Where can people either reach out to you or find out more about you or buy your book?
free at my website. It's derosagroups.com, DEROSA groups.com. They can hear about passive investments we have. If somebody listening wants to consider becoming an active operator, we do have training programs that teach people how to 10x their business in multifamily. And there's a click through to buy the book from Bigger Pockets, which is the best place to buy it. And you get a bunch of free new giveaways. They can do all those things. derosagroup.com, DEROSA.
Yeah, I should have bought it from Bigger Pockets because I bought it, I think, from Audible, and I didn't get any of the freebies.
I've got the money. I know.
Yeah. Awesome. Exactly. Maybe one for my kid. Hey, read this. All right. Thanks for spending some time with us, looking into our crystal balls a little bit for fun, telling us, kind of helping people decide, do I want to be passive? Do I want to be active? And how much of my portfolio do I want to dedicate to each one of those activities? It's maybe not important to do both, but sometimes it's important to know how much time and effort you want to spend with them. So I appreciate that insight there. And I guess I will see you at the next conference.
I would love that. I'll see you on the road.
Thanks so much.
Thank you.
Bye. So what did you think of that interview, Passive Income Adventurer? I love talking to people that I have been following or have been my kind of mentors without me telling them that they're my mentors, authors and speakers and people in my network. And just, they're always trying to add so much value. And Matt's definitely about that and helping people really to change their lives through real estate investing. I feel like our goals align really well with that because we feel really passionate about people becoming financially free, gaining that passive income so that they can become work optional and really thinking about the ways that you want to spend your time and what is most meaningful and what you're most passionate about. Whether that's starting a nonprofit, charity, whether it is taking a year off to just think about how you can impact your family and your world in the most effective way, doing something that really gets you excited. That's what we're about here at the Passive Income Adventures, the lifestyle design, and it may not look the same for everyone. In fact, it definitely doesn't look the same for everyone. If you would like to learn more about investing with Matt on his deals, head over to DeRosa Capital. And if you'd like to learn more about investing with us and the things that we're doing in order to fund our early retirement, head over to risecapitalinvestments.co and click on Invest Now, or if you'd like to create a login, get into our portal and start looking at the deals that we're investing in. As we talked about in the episode, we're really trying to focus heavily on cash flow right now, not only because we are trying to live without a 9-to-5 income and we need cash flow to be able to do that, but because the market has really just turned that direction, we're not seeing as large of increases in value, things, and so cash flow really has become king during this period of time. And keeping that cash liquid and keeping that cash moving so that when we do see a great equity deal come up, we're able to deploy into that deal and let our capital be tied up for a little bit longer, 3, 5, sometimes even 10 years of just enjoying a nice cash flowing investment or something that's going to appreciate really well once the market starts to stabilize. So if you want to have a conversation, if you'd like to have a conversation about more of these details and how this applies directly to you, your investment strategy and your current portfolio, would love to talk more about it. So jump in to our website, schedule a call, and let us know what you need in your portfolio so that you can go on more passive income adventures. We'll see you next time. Thanks for joining us.